Welcome back to the Loan Lads podcast. Today we're on episode 9. Now that we've already covered flips, ground up construction, rental loans, and interviewed or spoke to one of our top producing AEs, Caleb Baker, we're now going to take a zoom out and talk about the market in general and the trends that we're seeing in the lending space.
Yeah, and before we get started, make sure to check out parkplacefinance.com for any of our products, or if you want to reach out to inquire about a loan today.
So obviously there's a bunch of different markets within real estate. What are you seeing, Connor, in the real estate market in general overall, right?
Inventory. It's been rising, whereas in the past it was low.
Yeah.
So prices were consistently rising. People were going in and offering over listing price. That's not the case in today's market, right? There's a lot of inventory out there, and in some markets there's an influx of inventory, right? So prices are kind of plummeting. For example, that would be, specifically would be South Florida. Over there in like the Lehigh Acres, Port Charlotte, those areas you had a lot of builders go in and buy up a lot of land, build a bunch of spec homes, and they're all sitting on the market. So there is a massive influx of inventory down there, whereas some other markets maybe don't have that, and so the prices are still very stable.
Yeah, for sure. And really, as we see the influx of properties being put onto the market, really means two things for sellers. Number one, there's more competition out there. So maybe what they started doing when they initially bought into the flip or their ground up construction, the exit strategy may have to change, right? They may have to flip that into a rental, because as inventory grows, that means days on market typically increases as well. Property values typically decrease, and you may not get what you originally thought you were going to get for a sale of that property at that current time. Now, with that being said, we've talked about it time and time again of exit strategy, know what you're planning on doing, and also have a backup, right? So, you know, in those times and in those markets to where we're seeing now in some areas where we have an influx of properties, a lot of investors should maybe switch their mindset and go, okay, maybe I'm going to put this into a DSCR loan for 2 to 5 years, maybe 6-7 years, depending on where the market is. At that time, rent it out, try and, you know, get some cash flow on the property. If not, meet a 1-to-1 ratio, get the tenant paying some of the principal down, obviously your interest and your taxes and insurance there. And then hopefully in coming years, once the market shift changes, then the property values tend to increase, right, as the pool of or supply and demand decreases, or the supply of housing decreases, then obviously the demand increases, and then at that point you should be able to perform your exit. So even in market downturns, as an investor, there's still options out there for you. Yeah, and I think that ties into the other trend in the market is interest rates. That's the topic that you hear everybody talk about nowadays. You know, we get calls about it every day, or, you know, have rates dropped today? It's probably 3, 4, or 5 times a day, right? I think that's standard for anybody that's in the mortgage industry. But buyers are also curious, and if I was a home buyer and I didn't have my mortgage experience, I would be interested as well, because you see it all over online right now. That's
Google.
The main thing that people talk about, right? When you're talking about your primary residence housing or what the rates are, it's like the topic of conversation to get into. You know, that conversation in general. And
really in today's day and age in the market, rates are starting to stable out a little bit. Obviously in the boom years, they've been increasing. We've seen a significant increase over the last course of 4 years. And this year is really kind of the first time we've seen them start to stable out and drop a little bit. I think we got a 25 bip decrease a couple months ago, back in September. Very helpful, but they're still high, right? So like on a DSCR loan rates, I mean, you can get down to 5.75, which is great, but you got to pay a lot of points to get there, right? It's a hefty buy down fee. So like you're seeing a lot of stuff in the mid 6s still, and for investors, that's hard to pencil out. But for a home buyer, that makes your mortgage payment pretty high, which makes people uncomfortable to buy. So I think that's why you don't see a lot of home buyers in the market. But that also kind of brings the next advantage for investors. Like, even though rates are still high, it allows them to go negotiate better deals.
For sure.
And in turn, they can then go get a price for that property that does pencil out for maybe a higher rate. And then they'll stick it out until these rates do drop.
Exactly. And when you're going into a deal or a home or a property, there's different outcomes that everybody's looking for. If you're a home buyer, you may be looking for your dream home, right? and you're not in particularly looking at the property as an income producing investment. Now, investors are, right? So maybe an investor, it still pencils out for what they're doing with the property. It may be a short-term rental. They may have a renter that can rent for a higher amount, right? Compared to what the market's renting for. So, as an investor, even with the higher rates, if it still pencils out for what your strategy is, then you're going to be able to still buy that property. And kind of like you were saying, it gives you power in negotiation, because a lot of sellers, they know that rates are higher, and it doesn't mitigate all the primary residence home buyers. There's a lot of people out there that are still buying up homes, but it reduces that pool of buyers, which gives the investor more opportunity to go in, negotiate a good price, and actually benefit from either appreciation as soon as, appreciation of the asset as soon as they've bought it. They already have equity in the property just due to value versus purchase price. So there's pros and cons on every market trend, right? With high rates or with high market prices and low rates, there's pros and cons to everything.
Yeah, and I think we've also, with that comes the shift in exit strategy that you mentioned. Mm-hmm. We're seeing a ton more of like your BRRRR method that we talked about in a past episode, or build to rent, because a lot of these investors are seeing that the upside is actually holding on to that property for maybe just a little bit longer, 2, 3, 4, 5 years, allows them to kind of catch some of that appreciation as these rates come down, but also kind of get some equity back, because maybe, if they go list it and they're in a market that's tough right now, or maybe there's an influx of inventory, it's very hard for them to sell it. So they're kind of switching that strategy a little bit.
Yeah, absolutely. Where do you see rates going or heading in the next, let's call it, 5-year time frame?
That's a question that everybody asks. As a loan officer, you get that all the time. Mm-hmm. It's tough to say, because none of us know where the market's going, right? It's an unpredictable market, but just going off of data, we've seen that the Fed is talking about dropping rates again, and we've seen plenty of posts where they plan on dropping another 25, 50 bips here in 2025. Whether that happens or not, we don't know. But I would love for it to happen, right? And I think it's beneficial for everybody, but also it's going to help. I think that's why the market right now for investors is booming. This year alone has been busier than any year prior, with new investors and experienced investors buying. And I think the reason that is because people are predicting that these rates are going to drop.
They're optimistic.
And when rates drop, prices go up. Right, and that's because all these buyers come in as an influx and start buying up these properties, and maybe the inventory starts to drop a little bit, because people at that point,
it up.
Yeah, exactly. So at that point, I would hope so, and I think that's why you see a lot of these investors coming into the market. But my personal opinion is yes, I think within the next year or 2 years we should probably see rates come down. Hopefully a full percent, but for sure 25 to 50 bips.
Absolutely. And while we're on the topic of rates, obviously we do short-term loans as well. So what we're talking about is mainly for home buyers, what it means for them, and also the DSCR loan, which is your longer term, either 10-year IO, but typically the 30-year loans, right? Which over a 30-year span, difference in 25 basis points is a decent amount of money, right? However, whilst we're on rates for short-term loans, it really doesn't make that much of a difference, in my opinion. And I don't think that should be the be-all, end-all aspect of a loan that an investor is looking at. And the reason I say that is a lot of these investors are coming in for short-term fix and flips. Short-term fix and flip, we're talking 3 to 9 months generally. Right. And really the difference in a percent over that time on an interest-only loan based on the initial principal and drawn rehab funds, it's not going to hurt your profits too much. Yeah. It obviously is going to eat into them, but if you've got the right deal and you know that as an investor, the difference between a 899 rate and a 1099 rate shouldn't be the be-all, end-all of your deal there.
Yeah, absolutely. I think some more kind of market trends we're seeing as well, or you're seeing a lot of regulatory shifts, right? So for zoning and permitting offices, they have slowed down a ton. I think that's partially because of the amount of people actually building nowadays, where there's an influx of permits being submitted for approval or permit applications, so to speak. You've seen those start to slow down a little bit. Which, builders we've talked about in the past, we just want to make sure they're building in that time frame, that expectation in case they don't already have them in hand. And then I think one of the biggest regulatory shifts we're seeing is short-term rentals.
Right.
You're seeing a lot of markets start to regulate what they're going to allow, and they're like blocking off areas to where it's not allowing short-term rentals. I've got a prime example in New Braunfels here close to us in Austin. It's a prime short-term rental market. You've got the river out there. Everybody loves to go float. You got all kinds of stuff to do out there.
Downtown, have a couple of beers, bit of live music. There's Country Donny coming out there.
It's the Germantown, but you're starting to see that they're not shutting down Airbnbs, but they're making it particularly hard to have an Airbnb in downtown in the prime market. You're starting to see a lot of zoning come out to where it's not zoned or permitted to be a short-term rental, and I think there's a lot of markets starting to do that, making it tough for investors to buy in a prime area, but also short-term rent. So, as an investor, you just want to make sure you're checking that, especially if you're planning on buying a short-term rental. You want to make sure that it's zoned and allows for that in this market.
Yeah, absolutely. And what do you think the main reason for that shift is in these markets?
Yeah, I think there's a couple different reasons. One of the main ones is you've got a lot of people buying short-term rentals, and when they do that, it drives up the rent in the area because they're taking away those long-term rental properties. So they're trying to kind of stabilize the rents in the area to where, for example, if you've got too many short-term rentals, it could be almost not realistic to be a renter in the area as a long-term tenant because the price has been driven up so high. And then another reason I think is due to neighborhood nuances. So you have a lot of people who buy Airbnbs, and yes, families and older crowds buy Airbnbs. We also have younger crowds that do it, and they just love to terrorize the place. Not only the house in general, but you've got, they're loud, they like to trash the place, or maybe they trash the area, and it causes, parking issues. And I think the homeowners in those areas then become a little irritated, and they have complaints to the local governance. So.
Yeah, no, that makes sense. And then also what I've seen and heard in some areas, like for New Braunfels, it's not the biggest city, right? But if the Airbnb scene, anybody could have an Airbnb, it could technically turn into a ghost town to where there's not really residents that are living there, that have been living there for a long time. It's just people that are coming into the city or town as short-term renters and obviously enjoying what it's got to offer, but kind of takes away the community that's in those areas. So
yeah, absolutely.
Again, there's probably more items that the cities look at to why they're regulating these, but that's just a couple.
Yeah. All right. So what opportunities are you seeing out there for investors currently in this market?
Yeah, absolutely. So I'm seeing a lot of suburban growth, i.e. Investors are maybe moving away from the inner cities. Yep. In Austin especially, or for example, people are going out and building further out of the city, maybe 10, 15, 20-minute drive from the downtown. And the real opportunities in these suburban areas is, number one, there's a lot more long-term renters out there, as well as home buyers, right? But there is opportunities to where you can buy up land and do small subdivisions. And since you bought that in bulk and you're actually building in bulk, the cost per property in terms of labour and materials decreases. So there's real good opportunities to go out into those suburban areas and build, or maybe go find those older properties that have been out there for a while, get those updated, and either sell them or put them as long-term rents, right? In downtown areas, typically there's a lot of gentrification pretty much happening consistently. I know in Austin, the past 5 years, it's changed dramatically. Yep. With all the high rises going up. I think we're in the midst of building the tallest building in Texas, right?
Yep.
Which is nearly completed, and that whole landscape has already changed. The convention centre just across the road has been torn down, and I'm sure we're going to see some more growth and high rise there. So that's more like the bigger developer side of things. We see a lot of apartment buildings, condos is really on the bigger scale. But for the investors that we deal with at Park Place, we're really talking about your 1 to 4 family or small subdivisions, really moving out of the main city limits and going to suburban areas definitely brings opportunity.
Yeah, and I think in the last 2 years, you've seen a lot of families start to move in that direction.
Yeah.
So as an investor, you kind of saw the pivot 2 years ago where a lot of them were trying to invest in these downtown areas, not just Austin. You got like Atlanta, Georgia, for example, is a prime one. Or maybe Miami out in Florida, or there's a lot of other markets, San Diego, Los Angeles. You see a lot of these families starting to drive out of those downtown metropolitan areas, and you're seeing the investors follow, right? And so it's also created a lot of opportunities for fix and flips, not only just new builds, to where you can maybe go find a distressed property as a investor, fix that up, and then you've actually got a home buyer, a family buying that property from you, which makes it a little faster to turn those properties around.
Absolutely. And then what I see in terms of a correlation between people moving out of the downtowns and moving into suburban areas and the online job market, you can pretty much do every form of work now from online or from a remote location, right? Whereas previously, if you worked in banking, you worked in tech finance, I'm talking about Austin specifically, a lot of those jobs are centrally located in the downtown Austin area. We have the Google building, we have Facebook building, to where a lot of those jobs required people to be in office. Since COVID, a lot of people have been able to work remotely, and businesses really pivoted there, which is why we can see some of that outward growth into these suburban markets, to where the people that would work in these industries and jobs downtown are happy to move further out because they don't need to commute anywhere.
Yeah, and I think too, it's a matter of affordability, right?
Yeah.
In these downtown areas, you got to afford the taxes, which are significantly higher in the actual downtown metropolitan areas.
Yeah.
Partially due to the gentrification that you talked about, partially due just because in the boom 3-4 years ago, prices skyrocketed in most downtown metropolitan areas, which did force a lot of that growth out to the suburban areas as well. So where do you see the market going in the next 12 months personally, Joe?
So personally, I definitely do see rates continuing to decline slowly. That's going to be beneficial for a lot of people. I also see the build to rent or build to sell sphere of investing to continue to grow. It's getting big right now. I mean, 80% of my book of business is going to be build to rent or build to sell. So that's definitely going to continue to grow as due to all the things that we've just spoke about. And then I also see the suburban growth continuing to really make its mark and move outward of cities as well. Yeah,
I would say I agree with all that, and I think specifically the investors who are going to continue to buy smart are going to continue thriving, not just surviving the market. Right. So I think that's one key thing to look out for, is just buying right. Buy at the right price.
And that's what it takes to be an investor. The good investors, at the end of the day, this is their full-time gig. This is what they do to put food on the table. No matter which market you're in, there's benefits and downfalls of every single market that you could think of. So really adapting to each one of those markets and making sure that your strategy aligns with what's going on at the time of the market. Speak to your lender as well. That we work in this field every single day. We know what's going on. We see housing prices. We see rates. We know what's working. We know what's not working. So reach out to us, talk to us as well. We want to know what you're seeing. Likewise, you should want to know what we're seeing as well.
Absolutely. Well, that wraps up today's episode for episode 9. So make sure you check in with us next week for episode 10, which is going to be one of the, I think it's second to last episode of the season. Before we start to recap and go into season 2 in the coming year, 2026. Make sure to like, subscribe, and check out parkplacefinance.com.